The next bottleneck after AI chips may not be another chip. It may be electricity, capital access, and the shrinking ladder of investment opportunity. Welcome to Dragon Bullion! The economy lesson from June 24 is that leadership cycles move in stages. First, the market rewards the visible bottleneck. Right now, that bottleneck is AI semiconductors. Then the market starts asking what the next bottleneck will be after the first one becomes obvious. For this cycle, the next layer may be power grids, electrical equipment, data center, infrastructure, and software that turns AI capacity into productivity. This is not a random theme list. Data centers, AI models, robots, and automated factories all need electricity. They also need networks, cooling, chips, software, and financing. If the semiconductor cycle succeeds, it creates the next problem: how to power and operate the infrastructure at scale. That is why investors should not treat power grids as a boring utility topic. In an AI economy, electricity can become a strategic input. The condition is important. A next cycle theme is not investable just because it sounds logical. Investors need evidence, actual capital expenditure, order growth, grid upgrades, data center construction, equipment margins, policy support, and customer demand. Without those numbers, the theme stays a story. With those numbers, it can become the second leg of the AI infrastructure trade. The opposite case is also clear. If semiconductor demand slows before power demand becomes visible, power grid stocks can become too early. If companies talk about AI electricity demand, but cannot convert it into orders and cash flow, the market can punish them. The goal is not to chase the next buzzword. The goal is to understand the sequence. Power becomes the next bottleneck because AI is physical. A model may look digital, but the infrastructure behind it is concrete, steel, chips, cooling systems, transformers, transmission capacity, and power contracts. Every new data center adds load. Every robotics factory adds load. Every automation layer that runs continuously adds load. This changes how investors should think about electricity. In the old market, power infrastructure was often treated as slow and defensive. In an AI build-out, it can become a growth constraint. If the power supply is not ready, data centers cannot expand at the desired speed. If grid equipment is delayed, the AI capex cycle can hit a wall even when chip demand remains strong. Korea may have an advantage here because industrial power infrastructure and relative electricity cost structure can make it a useful test ground compared with parts of Europe and Japan. That does not mean Korea automatically wins. It means global AI companies may pay attention to locations where semiconductor capability, industrial infrastructure, and power economics line up. The investor checkpoint is simple. Watch whether power grid news moves from theme articles to actual investment. Track equipment orders, transmission upgrades, data center permits, electricity price policy, and partnerships between AI companies, chip companies, and energy providers. The theme becomes stronger when the physical build-out becomes measurable. Software is still part of the next cycle, but timing matters. Right now, the market is paying more for visible semiconductor earnings. Software, without immediate earnings proof, has less leadership power when rates stay uncomfortable. That does not destroy the long-term software thesis. It simply means investors need to wait for the right evidence. AI infrastructure creates software demand only when companies use it to reduce cost, increase output, or control workflows. A data center by itself does not guarantee software profits. The software layer must help businesses automate customer service, design, coding, manufacturing control, content production, logistics, or financial operations. That is when infrastructure becomes productivity. The condition is unit economic. Does the software reduce labor cost? Does it increase revenue per employee? Does it improve margins? Does it keep customers inside the platform? If the answer is visible in the numbers, software can regain leadership after the hardware cycle matures. If the answer remains only in demos and press releases, the market can keep discounting it. The risk is buying software too early while the market is still filtering for earnings proof. Higher rates make investors less patient. So, software deserves a watch list, not a blind overweight. The better entry may come when semiconductor leadership cools, infrastructure spending broadens, and software companies finally show cash flow leverage from AI adoption. China risk is not only about one economic data point. It comes from a larger structural change. China's growth was built during a period of globalization, export expansion, capital availability, and relatively favorable financing conditions. Now the environment is different. Supply chains are separating, geopolitical pressure is higher, and the global rate backdrop is much less forgiving. China also faces a difficult policy balance. Deflationary pressure argues for easier policy, but currency defense limits how aggressively rates can be cut. If a country needs to support growth but also protect the currency, corporate balance sheets can come under stress. That pressure can force restructuring in industries that looked strong during the cheap money period. This matters for AI, robotics, and electric vehicles. Chinese companies may be technologically competitive, but technology alone does not erase financing pressure, export restrictions, weak demand, or currency risk. A company can be innovative and still suffer if the macro structure becomes hostile. For Korea, China risk can travel through exports, foreign investor sentiment, currency pressure, real estate psychology, and industrial investment. If China weakens while the dollar-won exchange rate rises, Korean assets can feel a double pressure. Investors should not assume every China-linked rebound is durable. They should ask whether demand, funding, and currency conditions are actually improving. The third economy lesson is that the investment ladder is getting narrower. In the past, investors could often wait for broad rotation. If one sector became expensive, money might move into laggards, small caps, cyclicals, or cheap value names. That still happens, but it may happen less often in a world where capital concentrates in strategic assets. Large pools of money increasingly prefer assets that have policy support, productivity importance, scarcity, or direct connection to high-income capital. That can mean semiconductors, data centers, power infrastructure, dominant platforms, strategic software, and asset-rich companies. The more uncertain the macro environment becomes, the more investors may prefer proven leaders rather than broad recovery stories. This creates a difficult reality for smaller investors. Cheap does not automatically mean good. A stock can look inexpensive because it has no demand, no earnings upgrade, no policy support, and no strategic role. Waiting for broad rotation can become costly if the market keeps rewarding only the narrow group that owns the bottleneck. The practical response is not to chase after every leader at any price. The response is to build a hierarchy. First, identify the bottleneck assets. Second, wait for volatility and currency pressure to create entries. Third, use cash to rotate from weaker assets into stronger assets when the market gives a reset. In a narrow ladder market, Cash is not dead money. Cash is the ability to climb. The narrower ladder also favors asset owners. When surplus capital exists among high-income households, exporters, strategic companies, or asset-rich groups, that money does not always turn into broad consumption. It can flow back into financial assets, real estate, private businesses, and long-duration technology exposure. This can keep asset prices supported, even when the average consumer feels pressure. That gap can be confusing. Social mood may feel weak while selected asset prices remain strong. The reason is that the marginal buyer of assets is not always the average consumer. It can be institutions, wealthy households, corporations, or policy-backed capital. In that world, the assets that receive surplus cash can keep moving while weaker assets stay ignored. The condition is credible earnings and liquidity. Surplus capital still needs a destination. If leaders become too expensive, or if rates and currency pressure break the entry conditions, even asset owner flows can slow down. But when policy, earnings, and liquidity align, the same capital can reinforce the narrow winners for longer than many investors expect. The risk is social and political. If asset owners keep winning while labor and consumption weaken, policy pressure can rise. Regulation, taxes, subsidies, and industrial policy can all change the path of returns. Investors should watch who owns the scarce asset, but they should also watch whether society and policy allow that ownership advantage to continue. The sequence matters more than the slogan. Stage 1 is AI semiconductors because earnings and demand are visible now. Stage 2 may be power grids, electrical equipment, and data center infrastructure because successful AI adoption increases electricity demand. Stage 3 may be software and automation platforms because infrastructure must eventually turn into productivity and margins. Each stage has a different confirmation signal. For semiconductors, watch earnings, memory pricing, AI capex, and supply chain orders. For power infrastructure, watch grid investment, transformer demand, data center permits, electricity policy, and equipment margin. For software, watch revenue per employee, customer retention, gross margin, and real adoption inside enterprise workflows. Risk control also changes by stage. In stage 1, the main risk is crowded leadership and rate pressure. In stage 2, the risk is being too early before orders are visible. In stage 3, the risk is confusing impressive demos with real cash flow. The investor should not use one rule for every theme. The better approach is evidence-based sizing. Own the first stage leaders when evidence is strongest. Prepare a watch list for second stage bottleneck. Keep software on a proof-first basis. Use cash when the market becomes too crowded or when the $1 exchange rate, rates, and liquidity stop confirming the trade. Here is the checklist. First, ask what the bottleneck is now. Today, the answer is AI semiconductors. Second, ask what bottleneck appears if the current one succeeds. The likely answer is power, grid capacity, data centers, and operating software. Third, ask whether the theme has measurable orders and cash flow. Fourth, check macro pressure. If the $1 exchange rate rises, rates stay uncomfortable, or China risks its exports and sentiment. Do not size the trade as if liquidity is perfect. Fifth, avoid broad cheapness. Cheap assets without policy support, earnings proof, or strategic relevance can stay cheap. 6. Keep cash ready. In a narrow market, the best entries often come from sudden resets in the leaders, not from permanently weak laggards. Cash lets investors move when the market offers that reset. It also protects them when the narrative gets ahead of the numbers. The final rule is simple. Follow the bottleneck, not the buzzword. Buy the theme only when the bottleneck turns into orders, margins, and cash flow. Respect the macro line. And remember that the next AI winner may be the company that powers the system, not only the company that designs the chip. The lesson is this: AI leadership does not stop at chip. If the chip cycle works, the next question becomes electricity, infrastructure, software productivity, and who owns the assets that make the system run. China risk and high rate pressure make the ladder narrower. Money does not have to rotate into everything. It can keep concentrating in the few assets that solve real bottlenecks. So do not chase every future story. Watch the sequence. Semiconductors first, power and infrastructure next, software after proof. Keep cash for resets, and buy only where the future turns into measurable demand and defensible cash flow.